There are a lot of YouTube videos out there that go on and on about building a passive income through dividend stocks. And if you've watched some of these videos, you'll know that the way they're marketing these business models is because stocks pay out a high dividend. But this is a total misconception. Sure, buying a stock just because it could pay out a high dividend when compared to what you initially bought it for does seem very appealing, but this is a rookie mistake. The bottom line is if you're someone who's trying to build your long-term wealth by investing in stocks, then buying stocks just because they get a high dividend is not the way you want to do that. Don't forget to hit the like and subscribe button before we proceed. Warren Buffett, one of the biggest names in the business world, made public statements supporting the idea that when companies pay out a high dividend, that doesn't necessarily translate to be a good thing. Take Berkshire Hathaway for instance. Berkshire Hathaway is a very established American stock, but it has never given its stockholders any dividend, and the company benefited from the utilization of the cash. This begs the question that if other companies should follow in this line of reasoning, and instead of paying out dividends to the stockholders, they would start investing the money through other means, would they also stand to benefit from such actions? In an interview, Warren Buffett was asked if he thought not paying dividends was a good thing. According to Buffett, it all boils down to how they're going to strategically use the money. Companies like Coca-Cola and Gillette have a more specific enterprise, especially when we look at their products, which is different from Berkshire. Businesses that can strategically use their money to both develop their products and create a bigger market for their products and at the same time are still able to pay their stockholders and repurchase shares are all definitely on the right track, especially when they come to the point of really giving the investors the return that they so willingly spent their money on. So, while for some companies, the way that they can build up the market value for their investors' shares is to keep them within the company and slowly build the market value over time, you never know how long the company will be able to keep increasing that value. So, other companies who do send out dividends should still be given credit for knowing how to use the money in such a way that it would produce the highest benefit for them and their shareholders. If we look at companies like Microsoft, Bill Gates has around $4.5 billion retained within the company, and for them, at this point in their business venture, this is the right move. But that doesn't mean that this will be the right move forever. At some point, there will be a definite change that they will need to act upon so that they could keep the value of the company at a record high. For the companies that don't pay dividends, the underlying reason is that it is the company's belief that if they hold on to the dollar, it essentially increases the value of that dollar more than it could ever be as compared to when they give the dollar back as dividends, which should be the yardstick of whether or not companies should pay their dividends. If the money is worth a lot more when the company holds on to it rather than as a dividend being distributed, then the logical thing for the company to do is to retain it for as long as that value increases. But once the company sees that this is no longer the case, that's the time they would start distributing. But the thing is, some companies might not have a way of strategically spending that money within the company to potentially increase the dollar value that the investors pay. Let's say that in a year, the company was able to generate about $40 million, and for some reason, there are no other strategic ways to properly reinvest that money back into the company so that later on it would increase the value of the investment over time. So in this case, the company would be paying out the $40 million as dividends. The reason why some companies like Berkshire Hathaway can still be an American favorite despite not giving out dividends like other companies is that they're trying to use that money intelligently within their line of business and essentially increase the value of their money over time. And this is exactly how dividend policy should work. They need to be based on whether or not they give the shareholder a higher value as an investment that's being strategically spent on the company or as a dividend. Just imagine how much more value a company like Coca-Cola could get from spending money on the development of their products. There's a chance that investors could have earned more from Coca-Cola keeping the money than what they got from the company as a dividend. With this in mind, for some companies like Disney and Gillette, the best use of their capital could be lying in the repurchase of shares. The principles that we just talked about can't be appreciated if we don't talk about the reason why a company would even give out dividends to begin with. Now, to show you why a company that gives dividends can eventually rule out to be harmful in the long run, let's use one of the biggest retailers in the world as our example, Kroger. Kroger is an American company that happens to be the second largest general retailer. In 2020, they were able to make almost $2.6 billion in profits that year alone. So, what exactly should a company like Kroger do with all that revenue? One option would be to inject the money into the business operations. This investment would fund capital expenditures, which are things like building improvements, new site constructions, and expansion. If after all of those improvements the company still finds itself with a surplus of cash, that's when they can start to pay out the dividends. These cash payments that the shareholders get from their investment in Kroger come from that 2020 revenue. In 2020, Kroger paid out $534 million worth in dividends. This means that in 2020, each share that a shareholder held got about 50 cents. Now, I know that 50 cents might not sound like a lot, but looking at the Kroger stock value, there was a point in which Kroger stock went for about 30 per share. Another option that Kroger could use would be to repurchase some of its shares. When a company repurchases some of its stock, it lowers the number of shares, which leads to the remaining shares that are still under the company representing an even bigger stake in the company. And this was actually something that Kroger did end up doing back in 2020 when they repurchased about 1.3 billion. Shout out to all my viewers who have made it this far in the video. I hope that you guys have been able to learn a thing or two about the concept of the behavior in retaining and repurchasing stocks. If you guys like what you've been watching so far, make sure that you like this video and of course subscribe to this channel if you haven't already. Now that you understand why a company would pay out dividends, let's now talk about the main reasons dividends can actually mean harm to serious investors rather than promise and fruitfulness. The first reason is that some companies prioritize paying out dividends instead of reinvesting in their own company. When they do this, the company compromises their long-term growth, and all for the brief enjoyment of having a big payout. Now, this is exactly what Warren Buffett meant when he talked about how dividends aren't a controlling factor when we determine if a company is a good investment. Now, if Kroger was a small company that was still in the process of becoming well known, sending out the dividends would cost Kroger a great deal. The money used to pay out the dividends could have been used by Kroger to help fund improvements and expansions in the company and its products. In the long run, they could have used the reinvestments for things that could have been used to let the company grow even more. Take Amazon, for instance. Amazon is a very good example of a company that stands to gain more by having funds directed to its products and improvements. Why? Amazon is still at the point where it's continuing to rapidly grow. For this, Amazon will be needing funds to shoulder expenses like developing their websites or hiring more people to work for them. Enhancing these areas in the company can translate to a higher return on investment. The other reason why dividends can be harmful is because of high return expectations. People who have just started investing don't get the concept of injecting funds back into the company to give their investments a higher value in the future. All these new investors focus on high dividends, and this places pressure on the company to give out dividends even when the profit might not be able to maintain the usually high dividend yield. And so for new investors, they need to be careful because some of these high-yielding companies can become dividend traps. These novice investors buy their shares thinking that they will be able to yield high returns, only to find out later that the company can't sustain that demand. And there you go. That just about ends our video. I hope you guys were able to gain more knowledge about finance and investment. If you do like this video, make sure that you hit the like and subscribe button down below. If you want to watch more videos, go check out our channel.